Okay, well, hello everybody. This is the very tail end of Chapter Two's discussion that we didn't get to earlier in the week on Tuesday. That is, and I think we've probably resolved our technical issues. And again, I do apologize for these issues. It's not something that I foresaw happening, and but I do want to sort of make sure that we cover just a little bit that remains from Chapter Two. Chapter Two is really a chapter segment that deals with how we do recording and what some of the logic of recording to accounts is in terms of debits and credits, in terms of things like adjusting entries, and finally the final bit dealing with conversion from cash basis to accrual basis. And just as a bit of a review here, when we talk about a cash basis system, it's a much simpler means of operating in a lot of ways because of the fact that we simply book revenues when we collect the cash, and we incur expenses when we pay out the cash. And so a lot of companies use cash basis, but it's not appropriate for companies that are publicly traded who have to use GAAP accounting systems, which is strictly on an accrual basis system. So when we talk about cash basis accounting, though, it's much simpler to do, and a lot of companies use it. But at some point, it may make sense to convert from a cash basis to an accrual basis system. And so let's talk a bit about what some of the examples would be of making this particular move here. So there are a few examples we're going to have here. And the first of these that we're going to talk about deals with prepaid insurance. Okay. So if we were on a cash basis system, we would simply record insurance expense when we pay it. The problem is, and this is one of the sort of classic examples that create distortions in net income when we use a cash basis system, because insurance is one of those prepaid expense items that we put as asset until we actually use it up. And so in this case, what do we have here? Okay, so let's take a look at what's going on. So we had $20,000 cash paid for insurance during the fiscal year, right? So we're going to assume that's probably part of the insurance expense, but maybe not all. There's $5,000 in prepaid insurance at the beginning of the year. Well, that'll have to go into the insurance expense if we're doing it on an accrual basis, because remember, in accrual basis accounting, when we're accruing expenses, we're talking about when those expenses were incurred. That $5,000 was paid in a prior reporting period was not incurred. It was simply prepaid, which is sort of the nature of insurance. And so therefore, we're going to have to pick that up here this time. And then we ended up the year with $3,000 of prepaid expense for this year. In other words, $3,000 was not incurred. So the $5,000 that was paid last time is going to be incurred this time. Now we're going to assume the $20,000 all belongs to this particular year, but $3,000 was not used up, and which is why we have a balance in prepaid insurance. And so we ended up recording for insurance expense in this particular fiscal year $22,000. $5,000 we inherited from the prior accounting period. $20,000, which we're assuming is on our assumption here, is going to be that was actually used up and incurred during the period, but we had $3,000 that was not incurred. It was paid but not incurred, so we're going to carry that over to the next fiscal year, much as we did the $5,000 for this year. So as a result, $22,000 is the amount of recordable insurance expense for this particular accounting period. And that's really a pretty good example of what we're talking about when we're talking about the incurring of expenses in an accrual basis system. But we have to make these adjustments, and we make these adjustments at all the various places in which there's going to be a difference between cash basis results and accrual basis results. Sometimes they're not very significant. Sometimes they are. And we'll see a couple of examples here, and I'll let you decide what you think about these. So let's look at the second example here is a conversion cash to accrual. In this case, we have salaries. And so the particular example here is we have a company that paid $150,000 for salaries to employees during the year, okay? And you determine there were $12,000 and $18,000 in salaries payable at the beginning and end of the year. So in other words, $12,000 was carried over from the prior period, okay, as an expense, and $18,000 were payable at the end of this particular year. So we're going to assume that $150,000 applies as expenses for this particular year, but not the $12,000. So we're not interested in that because that was accrued back in the last accounting period. But the 18,000 in salaries payable is incurred. So 150 plus 18,000 is 168. And even though we pay the 12,000, we take that out because that's not part of the expense going forward. And so as a result, our salaries expense is 156. That is 150 plus 18 is 168 minus the 12,000. Yes, we're going to pay it, but it's not part of salaries expense. It's already been incurred in the prior accounting period. This is a good example also of how we recognize expense in the accounting period in which we're dealing with it. Okay, and then one final example here concerns, and this is the use of T accounts, which I think is kind of interesting here. And again, we talked about T accounts as being sort of a modeling tool, sort of a gadget, I guess. And so here we've got an example where assume this is a revenue example. So this is revenue recognition, where we have the amount of cash collected from customers during the year is 220,000. And you know the accounts receivable at the beginning of the year is 45,000 and 33,000 at the end of the year. All right, so we're not interested in the 45,000 here, simply because of the fact that that was, if we're going to an accrual basis, earned in the prior period. We're going to collect it, but this is not a cash basis system. We're only interested in what was earned during the year, and the money is secondary really to the recognition of revenue, and likewise with expense when it comes to that. So what are we going to do here? So we're going to assume that 220,000 belongs in this particular accounting period, and that we build it and we collect it, et cetera. So what do we have here? We have a situation where we have 220,000. We're going to take out the 45,000 that was earned in the prior period. We're going to add the 33,000. Yes, no, we haven't collected it yet, but we've earned it. That's why it's a receivable at the end of the year. And so we end up 220 plus 45 minus 33 is going to be 208. So the entry we'll make is we'll book receivables here, and we'll also book sales revenue here. And so this is how one element of what we call revenue recognition. And we're going to talk a lot more, both in intermediate 1 as well as intermediate 2, about this issue of revenue recognition and when we decide to recognize revenue under the accrual system. Okay? And if anybody has any questions about either of these are a little bit, you have to kind of look at them, and these are not the easiest examples in the world. And you got to kind of stare at them a little bit and say, well, what's really going on here? And sometimes I think the use of T accounts, in my opinion, is a great tool to sort of visualize what's happening. And that way we can sort of divorce the receipt of cash and the payment of cash in the case of expenses with the actual activities themselves, which is really what we're trying to get at, okay? And that's really the heart of accrual accounting, and which is why it differs from cash basis accounting. And again, as we talked a lot in Principles 1 about this, the reason we do an accrual system is to ignore the issues of cash flows, which can be a real distorting factor when it comes to income and expense, revenue and expense recognition, and ultimately the determination of net income. Also, it is quite possible that companies could manipulate cash payments or receipts in order to boost or reduce income, whatever the case might be, whatever they're trying to achieve. And so as a result, that might not be the most appropriate thing for us to do. So we want to go with an accrual system. And there's a chart here that you might want to sort of look at. It's actually in your text. I think it's illustration 219. And I would sort of dog ear this or earmark it, however you want to do it. But it sort of gives you an idea of what we do in order to make these determinations. And remember, we're talking about an income statement adjustments we're making, but they really relate back to the balance sheet. So when we talk about assets, we're primarily talking about receivables here. So if these assets are increasing during the year, we're going to add from cash basis to accrual. If they decrease, we're going to deduct them. And because assets and liabilities are really opposite one another, we just simply flip the script when it comes to liabilities. Increasing liabilities, we deduct from cash basis to accrual basis, and we add when it comes to a decrease in liabilities. And to make this a little bit more obvious and concrete, we'll do some examples here. And we'll sort of refer back to, to this particular graph here because I think it really is important for us to look at. So it's something I think you want to sort of have, sort of earmarked so that you can look at in the future. So a quick example: concept check cash to accrual basis. All right. So there's a little bit going on here, and I know that these are a little bit tedious, but this is really what we do in accounting, is deal with a number of different things going on, these sort of moving variables. And so in this example, what do we have? Dan White Draperies maintains its records on a cash basis. What we're trying to do is we're going to convert everything to an accrual basis. And during 2021, the company collected $75,000 from customers and paid $21,000 in expenses. Excuse me, depreciation expense of $8,000 would have been recorded on an accrual basis. So we can assume that $8,000 is going to be recorded this particular year. Over the course of the year, accounts receivable increased $7,000. Now remember, we got to go back to that chart here. If it increases, what do we do with that? We're probably going to increase the revenue here, right? So not probably we are. Prepaid expenses decreased $5,000. And accrued liabilities decreased $4,000. So what is Dan's net accrual basis income? Okay, well, let's do the example here. And I'm going to sort of flip back to this particular matrix that we had. And again, it's illustration 219 in your text. So we're going to start with $75,000 in cash receipts. Now, remember, in the in revenues and the cash basis system are quite simple. It's what you receive from customers, regardless of when the sale happens and whatnot. And again, part of the distortion here is that we can carry these over from one accounting period to the other. And sometimes, and I certainly saw this in my career, and especially in banking, where cash basis customers would ask their customers not to pay them until the year ended so that they could report that revenue on the next year and therefore not pay tax on it until then. So there's a bit of a manipulation, which is why the bigger companies, certainly the publicly traded companies, cannot use this system. But cash basis accounting, there's nothing wrong with it. It's just not as precise as GAAP accounting is. All right. So we have cash receipts of $75,000. We had some disbursements of $21,000. So we're going to record those. We're going to assume those were incurred during this accounting period. So we have cash basis net income. All right. All right. So we're going to start with this, and then we're going to depreciation expense. That was sort of given to us. Nothing too difficult there. And we have a decrease in prepaid expenses. What was the decrease in prepaid expense? We don't really know. It's not indicated here. Maybe it was insurance or it was rent. We don't really know. But what we do know is we have a decrease in an asset here, and so we're going to deduct that. So that $5,000 in decrease in prepaid expenses, we're going to make a reduction. As we do the conversion from cash to accrual, we're going to make that deduction. Okay. And again, I would have this handy. It's a deduction. It's a reduction in an asset. It's going to be a decrease in an asset. Okay. Decrease in income. All right. And then we have increase in accounts receivable. All right. So an increase in an asset, we're going to add. And you can see why here, because remember, when we talk about assets, I guess we're primarily talking about receivables. When it comes to liabilities, we're primarily talking about payables. But at $7,000, the accounts receivables increased. So we're going to add that to the income figure to cash basis in order to get to an accrual. And one other adjustment we need to make here is accrued liabilities decreased by $4,000. So we have a decrease in a liability, and we are going to add that thing back in. So as a result, we have accrual basis net income of $52,000. So we have a difference here. Now this looks like it's sort of minor a minor adjustment, and this is pretty close. 54,000 and 52,000. Those aren't too different. But what if we slap 6 zeros onto these? Then it would be a little bit more, a little bit different. But also this particular variance in terms of one income reporting period to method to another is in percentage terms not very big. But what if it is big? And sometimes they are. And again, subject at some point potentially to manipulation. So one has to be cognizant of the fact that this is not always going to be that close. Sometimes it is close. Sometimes it is not terribly close at all. And how users of financial statements will apply this is really up to what it is they want to do with financial reporting. And so this is really up to them. And this is why financial analysts can do what they want. And And when I say do what they want, as a former credit analyst, I could tell you that we would get financial statements and we would slice and dice them, chop them up, put things here, put things there, adjust LIFO to FIFO and all this and things we'll get to a bit later. But the use of worksheets is a pretty common area, not just from the external user perspective, but also internal, where you take, in this case, we have an unadjusted trial balance, debits and credits, they equal. We have the adjusting entries here. The adjusting entries have to equal each other because every entry has got to be balanced. And we have an adjusted trial balance, which is going to be different than this because we've made some changes. The difference here are these adjustments. And I know this is really small if you're looking at it in the video, but obviously it's all in the text. And from there, then you populate the income statement. And whether or not you want to use this sort of intermediary account that's sort of a holding or suspense account called income summary is really up to you. I'm not sure that everyone likes to do it, but it doesn't make any difference. You're going to end up with the same values here. Credits, these tend to be revenue figures. Debits tend to be expense figures when we talk about the income statement. And so as a result, you're going to end up with a figure here of net income, $2,917, okay? And from there, you're going to create the balance sheet. And so worksheets of all kinds of various formats and shapes and sizes are used everywhere in accounting. And there are a lot of these worksheets that are used just to simply lay out what's going on. I know in the tax world, we certainly use worksheets. In corporate tax, because we do a conversion from GAAP accounting to tax accounting, we make a number of adjustments that we have to do in order to comply with tax rules. And so use of worksheets is very, very common. And if you've taken accounting before, which I know you have because you're in this course, you will have seen that there are a number of different worksheets that are applied. And these are not, if it's done inside the company itself, these are internal reports. These are not prepared for the use by outsiders. This is not part of the GAAP statements at all. It just is something internal to be used in order to arrive at the numbers that are necessary in order to report information. So I also bring up the issue of external users because external users are free to do whatever they want with financial statements and make certain adjustments and whatnot. And I certainly recall in my days where we would take out certain expenses and whatnot. We would sometimes we would limit officers' salaries. And as a result, we would sort of add salaries back in to net income because we knew that we could force the issue if push came to shove and whatnot. So there are all kinds of various adjustments that users can make. And when it comes to big and publicly traded companies, financial analysts who look at these statements understand what they're looking at and they use these statements in order to make judgments about what the future prospects of the company are and how that affects their own particular business. Okay, so that's the use of a worksheet from there. And then I'm not going to talk about reversing entries. I think if you want to read that, you can. I don't know that it's a big issue. I'm not a big fan of reversing entries. I think it's a little bit it's kind of a lazy accounting in my view. But if you want to read about it, you can. If you have questions about it, you can. There's nothing. All you're really doing is sort of reversing the entry and reversing it back again. You're going to end up with the same number. Nothing is going to change with respect to the end result. But I just kind of think that you ought to be able to match up, some accrual with what it referred to in the first place. Okay. All right. And then one final topic, and I think we talked a bit about this before, but we didn't really finish it, and that's the idea of subsidiary accounts and how they relate back to some larger account or control account. And what we're talking about here is that a lot of accounts everywhere in the accounting world, probably the majority, are actually subsidiary accounts. If you have a P&M bill, right, you have your unique account number that identifies you, and it's different than anyone else's account number, and it really is a subsidiary account. You have charges that are levied against you, you pay those, and you get a credit against those and whatnot. And they're ultimately, as they're creating receivables for themselves, they're collecting the cash, reversing crediting the receivable out, collecting the cash and whatnot. But as this is being done, you're going to have all these receivables ledgers that are being posted to. When we talk about a subsidiary ledger, we're really talking about the book of original entry. And every time we make a sale or whatnot and create a receivable, we're actually posting to a subsidiary account. We're going to credit it out once we have received the cash and whatnot. So the general ledger will be accounts receivable in general. So just as a sort of a little snapshot here, you've got 5 different clients: Leland High School, Mr. John Smith, whatever, $3,295, which we're going to then move over here and put into the general ledger. All we're really doing is this folds into this. This is a subsidiary to this. So it's not like we're crediting this out, because we don't want to do that yet until we actually collect the money. But we're sort of moving it over here because that's really where it belongs for reporting purposes. And notice that we're doing this as of the end of a monthly period. So we're assuming here that we're doing some financial reporting, and monthly is a little bit frequent. Certainly quarterly accounting is the minimum for publicly traded companies, but there are cases in which companies want to do monthly reports, monthly statements, and it can be in compliance with some sort of outside lenders requirements and whatnot. So these fold themselves into that particular larger account. And then we have special journals. And this is an interesting topic here, because these are basically books of original entry that capture very specific things, like cash receipts, cash disbursements. Those are probably the most obvious, but also sales and purchases. I talked a bit about purchases earlier. The purchases account is simply using a periodic inventory system where we're simply booking every purchase into that journal. We're just booking it into it, then we'll make the adjustment later once we're trying to come up with cost of goods sold. And I think we did talk about some of the limitations of a periodic system versus a perpetual system, where we get inventory and we book it straight into inventory, take it out of inventory at the time that we make the sale. But nonetheless, for smaller businesses or ones that don't have this ability or knowledge to do it, we could use a purchases journal. And what's interesting is it is more efficient in the sense that every kind of cash receipt and disbursement goes straight into this, and so we're accounting for cash on a more or less real-time basis. But we don't post individual transactions to the GL. Instead, we report them periodically. We accumulate them, and we tabulate them, and we summarize them, and we simply book them into the control accounts to which they refer, whether it's sales or whatever the case might be. And and it talks about the idea of specialized training. I don't know how specialized the training needs to be, but it does have to be done accurately, because if it's done incorrectly, it's going to be difficult, because you've got to sort of track down what happened. So a sales journal is simply a book of original entry for cash sales that are done, or credit sales, whatever the case might be. If it's a credit sale, it's going to go, you're going to be debiting the account receivable account. If it's going to be credit sales, you're going to book to sales revenue right away. And all of these accounts receivable, like we showed a second ago, we had these 5 different customers, are all going to have their own subsidiary ledger, assuming these are credit sales. And so let's go back to this particular example here and talk about these customers. I think this is for the month of, what is it, August? Oh my God, yeah, month of August. So we have a July balance and whatnot. We don't really care about that, but we did book. We recorded $1,500 in sales from Leland High School, or to Leland High School, John Smith, all these, and so $3,295. And so these are all individual subsidiary accounts that we're going to sort of move over here in order to be able to record this and to book the debit accounts receivable and the credit sales revenue balance transaction. These are not been zeroed out yet because we haven't collected them. So they're accruals, they're carryovers. We're going to collect them at some point. I think we have an example here where we collect. Yeah, we do. We collect. Well, we're going to get to that in a second. So in this case, let's just focus on Leland High School. They have a customer number 801. And again, when we talk about subsidiary accounts, sometimes these numbers are quite long. If you look on your P&M bill or utility bill, whatever, it's a pretty long number. I just happened to look at mine the other night. It's many, many digits. But nonetheless, you get the idea. It's a unique number that assigns itself to one particular customer. And this is used in a lot of other areas, a lot of other purposes, where you can find out how, where most of your sales are going to, and who they're dominated by, what kind of a customer, if you want to sort of sort these by institutional customer, nonprofit, government, whatever. There are a lot of reasons that we would want to assign those numbers, and the number formatting arrangement may align themselves to that. But And that's the beauty of computers, that we can sort of sort and slice and dice these. Okay. So in this case, what do we have? We have $1,500 we sold, and it was done on August 5th. And so as a result, we have a debit balance in that subsidiary ledger for that particular client and that particular client only. And then at some point, we'll be collecting cash for that, and we'll record a debit to the cash account. And if it was a credit sale, we'll record the credit to accounts receivable in order to balance that out. And what that looks like here in the case of Leland High School is they paid $750 of the $1,500 that they owed as of the end of August. I guess it wasn't the end of August, but they incurred it on August 5th. We recorded the debit to accounts receivable. They paid $750 on August 17th, and so we're going to reduce part of that balance down. And so what that looks like, and kind of mixing and matching here, you're going to have a debit to cash of $750, and you're going to credit accounts receivable, which is what we've done here. And so as a result, they still have a balance of $750 that they owe, and presumably will pay at some point after the 17th. But this is the initial transaction. But notice that we adjust the subsidiary balance once the payment is received for that particular transaction. And this is what happens all day, every day. In fact, bigger companies will have accounts receivable departments that really do very little other than simply post these transactions as they're received. Post them to customer accounts, maybe bill customers if there are late payments, maybe send reminder notices out or whatever you want to call it. Maybe calling customers up and saying, hey, we need to be paid, whatever the case might be. This is really what one of the main functions of the accounts receivable department are, is to manage these receivables. And we talked a little bit in 2110 in the introductory course about how we manage receivables and how we try to collect them as quickly as possible. Sometimes easier said than done in terms of how operational that idea is. Okay, so that's how we're sort of managing that individual issue there. And so that really does it for all that I've got to talk about there. I didn't have very much more to do, fortunately, and but I did sort of want to make the change to the due dates, at least in my section, the Attend Anywhere section. I know that these videos are used in Natalie's section as well. I can't speak to what her due dates are, but I deferred chapters 2, 3, and 4 by a week, and just to give you more time to review these. I did not anticipate we'd have some of these Zoom issues that we have. Hopefully those are behind us now. But we started on chapter 3 at the end of this week, which is week 3 that I'm recording this. And we're going to probably get all the way through that next week. And so we have really 2 weeks to cover chapter 4, which is kind of good. It's nice to have more time to cover things as opposed to less. And it gives us more time to actually do examples here in class, so that everyone can kind of get a feel for how these relationships work and how we make these entries. Okay. All right. Well, hopefully everyone is able to view this. And again, feel free, whenever you view this, to record your attendance in the attendance link under discussions. And have a great weekend. I'll see you next week.